Our task for today is to complete this problem we had started earlier. We've already completed these transactions that have occurred. The list of transactions, just for review, is seen here. We have transactions A through K. We've already posted them on this matrix into the specific accounts that have been affected, and we have account balances for all of our accounts here at the bottom. Our job now is to create financial statements from this information. You should have already reviewed the lecture on financial statements and be familiar with what it takes to create them before viewing this particular program, but we'll assume you've done that. And so our first task is to create the financial statements for this company. The financial statements, as you know, have to be created in a specific order. The income statement first, statement of owner's equity second, and the balance sheet third. And we have already set up templates that have done some of the work for us here. We already have headings on the income statement. The name of the company is Billy Consulting. This is an income statement, and the date is this income statement is for a month that is ended June 30th, 2000X. We have indications here as to what needs to be filled in order to complete this income statement. As we know, income statements are our fees that we've earned less the expenses that we've incurred, which will give us hopefully a net income. If for some reason our expenses would be higher than our revenues, we would have a net loss. So let's start filling in the information we need here. Again, we've already filled in the accounts here. We know that we have a revenue account called fees earned. We know that we have expense accounts for rent, salaries, supplies, truck, and miscellaneous. And all we need to do is fill in the balances in each of those accounts after the transactions have been completed. So let's go find the balance in our revenue account. And right here is our fees earned, and we find that our ending balance in our fees earned was $9,500. So I'm going to put $9,500 in here. And next we just need to go find the balances in our expense accounts. And again, we're going to look back here, and here is our rent expense is $500, salaries is $475, supplies is $300, and let's see if we can put those in here. $500, $475, and $300, and then we need to get our truck expenses and our miscellaneous expenses, and they are right here. Truck is $150, miscellaneous is $75, and so we put in our $150 here and our $75 here. Notice that on our matrix here, those balances were negative, and we're putting in positive numbers. The reason for that is that expenses affect owner's equity negatively, but when the account balances are reported, and we'll see this in the next chapter as we move from recording this method into a more traditional method, that the account balances are always positive numbers, and so we have recorded them as such here. We now have to total up our expenses, and if we sum these numbers, we get $1,500 as our total expenses. And so in order to report our net income, in this case a profit for this particular company for the month, our total revenues $9,500 less our expenses of $1,500 will show us that we have net income of $8,000 for this month for Billy Consulting. Now we're going to need this number right here, the $8,000, in order to complete our statement of owner's equity. So remember this number. We're going to need to plug it in down here. That's why they must be prepared in a specific order, because in order to finish this financial statement, we need to get the number from this one first. So let's move on to the statement of owner's equity. We see here that the first step in preparing a statement of owner's equity is to enter the beginning capital balance on June 1st. Well, it's simple this time because this is a brand new company, and at the beginning of June there was no balance in the capital account. Now the next step is step 2, which is any additions to the capital account over time. And remember from our previous lecture, there are two possible ways to increase the capital account. One is the owner can make contributions, and the second is that net income. And we have both of those cases in this particular example. Here's our net income. It's $8,000. We might as well fill that in while we're here. And then our owner made an initial investment in the business. And if we look back at our matrix, we look at the capital account for the owner here. We see that the owner initially contributed $20,000, and there were no other contributions by the owner. So our ending capital contribution balance there is $20,000. So the contribution by the owner, $20,000. We can use this line to summarize our total increases to capital. 20,000 plus 8,000 would be 28,000 total increases. Step 3 is to summarize the subtractions from the capital account over the period. Again, we have two choices here. The first would be if there was a net loss to the business reported through the income statement. That is not the case for us here. We had a net gain or a net income, a profit for the business. The other thing that can affect the capital account negatively is withdrawals by the owner. And so I believe we had some of those here. The owner withdrew $600 for personal use in our last transaction, and that made the total balance in our drawing account $600. So the total withdrawals by our owner were a negative $600, and we can indicate that with a bracket, which is a traditional way of indicating negative numbers from an accounting standpoint. And so overall, step 4 is to determine whether we had an overall increase or decrease to the capital account over the period. And our increases were 28,000. Our decreases were 600. So it's an overall increase to capital. 28,000 less the decreases of 600 shows a total increase of $27,400 for this particular company for this particular period. The last step, step 5 in creating our statement of owner's equity, is to report our ending capital at the end of the financial period, which in our case is June 30th, the end of the first month. And what we do is we start with our beginning number, which in our case was 0. And as long as it's a net increase, we're going to add this number. If for some reason it was a net decrease to owner's capital, this would be a subtraction process. But in our case, 0 plus 27,400 shows our ending capital value for Billy Consulting at the end of June to be 27,400. Now again, we're going to need this particular number in order to complete the balance sheet, which is the next financial statement that we're going to be completing. And here we see our balance sheet. This balance sheet is in the report form, which means the assets are listed on top, then the liabilities below that, and the owner's equity yet below that. The other option is the account form, which shows the assets here, and then liabilities to the right, owner's equity below that. It allows us to add total liabilities and owner's equity and compare them side by side to the total assets to assure that we have the same number. Either one's acceptable. We can use either one. The book allows that. I prefer the account form, but we will complete this one in the report form, so you get an introduction to that. So what we need here are, we see again that we have our heading, Billy Consulting. This is a balance sheet. Note the date here. The date on the balance sheet is always a specific date, a snapshot in time. Here's what our balance sheet looks like today. Tomorrow it will change, and it's not reporting information in a historical fashion like our income statement and statement of owner's equity. They let us know what happened over the period of time, in this case a month. The balance sheet is just saying, right now, here's what we've got. Again, we grab these balances from our matrix over here, and cash is $24,450, and accounts receivable is $2,500, and supplies is $900. So $24,450, and I can't remember what that number is already. It's $2,500 and $900. $2,500 and $900. Our total assets would then be to add these three numbers together. That gives us $27,850 as our total assets. The liability section includes all of our liability accounts, in our case only one, accounts payable, and we need the balance from our accounts payable from our transactions here, and we see that it is $450. So we would go over here and record $450. And finally, in our owner's equity section, our Billy B capital account, the ending balance comes from our statement of owner's equity right here, $27,400. So $27,400. And then finally, the last thing we have to complete is total liabilities and owner's equity, which is $450 plus $27,400. That gives us $27,850, and we see that the accounting equation has remained in balance. Our assets equal our liabilities plus our owner's equity, which is $27,850 in both cases, and so we've concluded our balance sheet. I hope this demonstration has helped you in understanding how to take information from transactions to recording transactions to creating reports that are usable by stakeholders in the form of financial statements. We look forward to seeing you next time at our next discussion.